Hello, everyone. Today is Tuesday, March 17th, 2026. Hope everyone is doing well mentally and physically. Welcome to another episode of Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC, your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. For today's podcast, we will be discussing another helpful and very practical tip you can use today as you get your taxes prepared during this tax season. We are taking a deeper dive into vehicle expense tax deduction for business owners. While many are already familiar with this business tax deduction, there are a few nuances that can disqualify this particular tax deduction. Our discussion today will help you navigate the business vehicle expense tax deduction accurately, stress-free, and compliantly. So without much further ado, let's crank it up and get straight to it.
Today we are tackling something that sits right in the driveway of, well, pretty much every self-employed person out there.
Yeah.
It is a tool, a burden, a joy, and if you play your cards right, a massive tax shield. We are talking about your car.
It is surprisingly one of the most significant line items on a tax return for entrepreneurs. Yet it is also the one where people leave the most money on the table.
Right.
Or conversely, where they accidentally trigger an audit because they, just didn't follow the rules.
Exactly. And usually when we talk about taxes, eyes just completely glaze over. But today is different because we've got our hands on a really practical guide.
We do.
It is titled Understanding Vehicle Expense Deductions for Self-Employed Business Owners. And honestly, the mission for this deep dive is pretty simple. We just need to decode the choice between the two main ways you can deduct your car.
That is right. You basically have the standard mileage method and the actual expenses method.
Right.
And while that sounds like a boring math problem, like A versus B, it is actually a highly strategic decision.
I love when you say strategic. It makes me feel like I am, playing 3D chess with the IRS.
Well, you kind of are. The hook here, and what I really want listeners to understand early on, is that this is not a decision you make when you are filing your taxes in April.
Correct.
This is a decision you ideally make the moment you buy the car and start using it for business.
Wait, really? The moment you buy it?
Yes. Because, as the source material points out, the choice you make in year one can actually lock you out of options forever.
Wait, forever? Like until the car dies?
For the entire life of that vehicle in your business, yes.
Wow.
There are some one-way doors in the tax code, and this is a big one.
Okay, let's unpack this immediately, because that sounds, well, terrifying. But before we get to the scary locked-in forever part, let's just lay the groundwork.
Good idea.
We have these two roads, standard mileage and actual expenses. Let's start with the one that seems, standard.
The standard mileage vehicle deduction. It is exactly what it sounds like. It is the simplified method. The IRS tries to make it easy for you here.
Thank goodness.
Instead of tracking every single oil change and tire rotation, you just track how far you drove for business.
And here is where it gets really interesting for anyone listening right now. We have a specific number from the source for the tax year 2025.
We do.
The IRS has actually bumped up the rate.
They have.
But
for 2025, the standard mileage rate is 70 cents per mile.
70 cents. Now, just for some context, the source mentions it was 67 cents in 2024. So we are looking at a 3-cent increase.
Which I know might not sound like a lot when you just say 3 cents out loud.
Right.
But if you are driving 10,000 or 20,000 miles a year for your business, maybe you are a real estate agent or a mobile salesperson or a consultant traveling to clients, that really adds up.
Let's do the quick math on that.
Yeah.
If I drive 10,000 miles for work, it's 70 cents a mile. That is a $7,000 deduction just for driving.
It's for driving. And you have to understand why the IRS does this. They aren't just being generous.
Obviously not.
That 70 cents is calculated to cover the average cost of fuel, insurance, wear and tear, and depreciation. They are accounting for fluctuations in operating costs. So like if gas prices spike or inflation hits the auto repair market, they bake that all into this single number so you don't have to do the granular math yourself.
It is the easy button.
Essentially, yes. You log the miles, you multiply by 0.70, and you are done.
But there is a hidden opportunity here, isn't there?
Yeah.
The source kind of alludes to the fact that this rate is an average.
That is the key word, average. It is an average based on a composite of vehicles across the entire country.
Right.
But your vehicle might not be average.
So if I'm driving a highly efficient hybrid Or maybe a small electric vehicle that costs literally pennies to charge and almost never needs maintenance. My actual cost per mile might be, what, 40 cents?
It could be very low, yes. Maybe even 30 cents depending on your local electricity rates. But the IRS still allows you to deduct the full 70 cents.
So that spread the difference between my 30-cent real cost and the 70-cent deduction is essentially tax-free profit, or at least an extra tax shield.
It is an efficiency arbitrage. You are getting a deduction that exceeds your actual cash outflow. That is one of the very few times the tax code actually smiles on you for being efficient.
I love that. Efficiency arbitrage. Okay, so that is the sunny side of the street, but, and there's always a but, with us, the source makes it clear that the easy road isn't the only road.
Right.
There is the actual expense method. And honestly, just by the name, it sounds exhausting.
It is certainly more labor-intensive. When we talk about actual expenses, we mean everything.
Everything.
The source lists them out: fuel, oil, maintenance, repairs, insurance, registration fees, and the big one, depreciation.
So if I buy a new set of tires, I have to save the receipt.
Yes.
If I get a car wash.
Save the receipt.
If I pay my monthly insurance premium.
Save the statement. And here is the kicker. You don't just get to deduct the total of those bills.
What do you mean?
You have to allocate it. If you use your car 60% for business and 40% for personal errands, you can only deduct 60% of that gas bill, 60% of that insurance bill.
Oh, wow. So you are not just tracking money, you are still tracking mileage to prove the percentage split.
Precisely. You cannot escape the mileage log.
That is brutal.
Even with the actual expense method, you need to prove the business use percentage. The burden of proof is much higher here because you need meticulous records for every single penny you claim, plus the log to back up the percentage.
So this begs the question, why on earth would anyone choose the hard path?
Good question.
If the IRS is giving me a clean 70 cents per mile, why would I ever bother saving a wrinkly receipt for a $40 oil change?
That is the million-dollar question, or maybe the $1,000 tax savings question. It usually comes down to the vehicle itself. Remember how we said that the standard rate is an average?
Right, the composite average.
Well, what if you are on the other side of that average?
Oh.
If you are driving a very expensive, heavy-duty truck that gets maybe 12 miles to the gallon and is expensive to insure and maintain, your actual cost per mile might be way higher than 70 cents.
I see.
In that case, taking the standard rate means you're actually losing money. You are leaving a legitimate tax break on the table.
So, to use an analogy, the standard mileage is like buying a suit off the rack.
Okay.
It fits most people pretty well, and it is quick. You just grab it and go.
Yeah.
The actual expense method is a bespoke, tailored suit.
Yes, exactly.
It takes way more measurements, way more time. But if you have a unique body shape, or in this case, a unique vehicle profile, it is the only way to get a perfect fit.
That is a perfect analogy. The source also mentions this method is often preferred if the vehicle is used exclusively for business.
Exclusively, like 100%.
Right. If it's 100% business use, think of a floral delivery van or a dedicated plumbing truck, the math gets a little easier.
Because you aren't doing that 60-40 split we talked about.
Exactly. You aren't constantly splitting out the personal percentage. But you still need every single receipt.
Okay, so we have the easy button, which is standard, and the bespoke suit, which is actual. Now we need to talk about that trap you mentioned in the intro.
The year one decision.
Yes. The source calls this a rule about switching between deduction methods.
This is the most critical takeaway from the entire document. If you take nothing else away from this deep dive, listen to this part.
Lay it on us.
The IRS allows you to switch methods, but there is a very specific direction you have to travel. Think of it like a one-way valve.
Okay.
If you choose the standard mileage deduction in the first year, the year you actually place the vehicle in service, you preserve your options.
Preserve my options for later.
Yes. In year 2, 3, or 4, you can switch to actual expenses if you want to. You can flip back and forth, essentially, though there are some complexities. But you start with the option to switch.
Okay, so starting standard keeps the door open. That makes sense.
Correct. However, if you choose the actual expense method in year 1, if you start by depreciating that car and itemizing costs right out of the gate, you are generally stuck with that method for the life of that vehicle.
Whoa, sup.
You cannot switch back to the standard mileage rate in later years.
So it literally is a one-way street.
It is a one-way street. If you start with actual expenses, you are locking yourself in.
That is huge.
Yeah.
Because I can easily imagine a scenario where someone buys a car And in the first year, they have a ton of repairs, or maybe they buy a bunch of custom accessories for it.
Right.
And they think to themselves, oh, I will do actual expenses this year because my costs are way higher.
Exactly. Or, more commonly, they want to take a massive depreciation deduction.
What does that mean in this context?
There are tax rules, things like bonus depreciation or Section 179, that allow you to write off a huge chunk of the car's purchase price in the first year.
Oh, I've heard of that. The heavy vehicle deduction thing.
Right. That is very tempting if you had a high-income year and want to aggressively lower your tax bill.
So they take the big write-off in year one using actual expenses.
Right. But then in year 2, the car runs great, no repairs, gas is cheap, but they drove 20,000 miles.
Oh, I see where this is going.
They look at the math and realize, oh man, the 70-cent standard rate would give me a huge deduction this year, much bigger than my actual gas receipts.
But they can't take it.
They cannot take it. They are locked into tracking actual expenses because of that year 1 decision.
That feels like such a gotcha moment. Why does the IRS care so much?
It is designed to prevent people from double dipping on depreciation.
Double dipping?
Yes. The standard rate actually includes a component for depreciation. It is baked right into that 70 cents.
Okay.
The actual method calculates depreciation completely separately. So if you wrote off the whole car in year 1 using actual expenses and then switched to standard mileage in year 2,
you would be getting the depreciation again inside the 70 cents.
Exactly. You would be writing off the depreciation component of the standard rate again. You would effectively be deducting the cost of the car twice. Ah, okay. That actually makes perfect sense. They aren't just being mean, they are protecting the math.
Exactly. It is an accounting safeguard.
Speaking of depreciation, the source threw in a little nugget of complexity there too. It said something about if you start standard and switch to actual, you are restricted on how you calculate depreciation.
Right. This is getting into the deep weeds, but it matters.
Let's hear it.
If you start with standard mileage, thereby preserving your flexibility, and then in year 3 you decide to switch to actual expenses, the source says you are allowed to do that.
Right, the one-way valve allows that.
But for the depreciation part of your expenses in that 3rd year, you must use the straight line method.
Okay, straight line. Translate that for us non-accountants.
Sure. Without getting too technical, there are ways to accelerate depreciation. That basically means taking a huge chunk of the car's value as a tax write-off in the first year or 2.
The aggressive stuff you mentioned earlier. Exactly. Accelerated depreciation. The IRS is saying if you switch from standard to actual later in the car's life, you cannot use those aggressive accelerated methods. You have to use the slow, steady, straight line method.
So it is a literal straight line on a graph, just an even amount every year.
Exactly.
So you do pay a little price for that flexibility.
Yeah.
You lose the ability to do the super aggressive write-offs later on.
It is a trade-off. Flexibility versus maximizing immediate write-offs.
This is why I love this stuff. It seems so dry on the surface, but it is actually a gamble. You are betting on your future behavior and your car's future reliability.
It is entirely risk management. You have to ask yourself, do I need a massive tax break today using actual expenses, even if it creates a receipt tracking headache for the next 5 years?
Right.
Or do I want a steady, simple deduction that keeps my options open with the standard mileage rate?
Now, we need to clarify who is actually allowed to play this game.
Yeah.
Because the source has a whole section on eligibility and business entity.
Yes, very important.
I feel like a lot of people just assume, well, I have a business, I can use the 70 cents per mile.
And for many, that is true. The source specifies that self-employed individuals, and this explicitly includes sole proprietors and partners in a partnership, are eligible, but there is a corporate carve-out. The source explicitly states that the standard mileage vehicle deduction is generally not available for businesses organized as corporations or LLCs that have elected to be treated as corporations.
That is a massive distinction.
It really is.
So if I form an LLC and I tick the box to be taxed as an S Corp or a C Corp, I might have just lost my 70-cent easy button.
In the way a sole proprietor uses it, yes. You cannot just list standard mileage on the corporate tax return in the same simple way.
So what do those people do? The ones with S Corp?
If you are an S Corp, you are considered an employee of your business. The corporation usually has to reimburse the employee, meaning you, for the business use of a personal vehicle.
How does that work?
This is often done through what is called an accountable plan.
An accountable plan?
Yes. Basically, you submit a mileage log to your own company. The company writes you a physical check for the miles driven at the federal rate, that's 70 cents.
Okay.
The company deducts that reimbursement as an expense, and it is totally tax-free to you as the employee, but it requires much more formal paperwork.
So if you're incorporated, you really can't just wing it. You need a system in place.
Exactly. And if the corporation actually buys the car itself, meaning the title is in the company name, the corporation absolutely must use actual expenses.
Really?
Yes, a corporation cannot use the standard mileage rate for a vehicle it owns directly.
That is a detail that I know trips up so many people. They go buy the car in the company name, thinking it is cleaner, but they accidentally force themselves into the complex accounting method.
It happens all the time. This is why the LLC label is tricky. An LLC can be taxed as a sole prop or as a corporation. How you ticked that box with the IRS determines your car strategy.
It connects everything back to your legal structure. You cannot just look at the car in isolation.
Never. It is all connected.
Okay, so let's try to summarize how someone actually makes this choice in the real world. The source gives us a few key factors to consider.
Right. It basically boils down to three main things. First, vehicle usage. What is the mix between business and personal?
Right. If it is the family SUV that you use to pick up kids, get groceries, and only occasionally drive to a client site, say maybe 10% business use,
then standard mileage is almost certainly the way to go. Tracking 10% of every single gas receipt and 10% of every car wash is a nightmare for a very small tax return.
the juice isn't worth the squeeze.
Exactly.
Conversely, if it is a dedicated work van,
Then actual expenses becomes much more viable because you are capturing 100% of those costs. You don't have to split the math.
makes sense. Factor 2.
The nature of the business.
Yeah.
Are you a courier driving 50,000 miles a year?
That is a lot of driving.
It is. And that high mileage times 70 cents is going to be a massive deduction. It will likely beat your actual gas cost unless you are driving a literal tank.
And the third factor,
The expense profile of the car itself. As we discussed earlier, the gas guzzler versus the EV. The old car that needs constant repairs versus the brand new car under a comprehensive warranty.
if you have an older car that breaks down every single month, the actual expense method allows you to deduct all those painful repair bills.
Yes.
The standard mileage rate doesn't care if your transmission just blew up. You still just get 70 cents a mile.
That is a great point. The standard rate assumes a functioning average car. It doesn't sympathize with your $3,000 mechanic bill.
It really doesn't. Now, regardless of which path you choose, standard or actual sole prop or core, there is one constant that the source hammers home repeatedly.
Documentation.
It is the unsexy truth of business.
The source uses the phrase maintaining meticulous records, whether that is a physical mileage logbook in your glove compartment, an app on your phone, or a literal shoebox full of gas receipts.
It doesn't matter as long as you have it.
Right. Because if you are audited and you don't have the log, the deduction vanishes.
And when you say vanishes, you mean
I mean, the IRS disallows the deduction completely. You owe the tax back, plus penalties, plus interest. The IRS rule is essentially, if you can't substantiate it, it didn't happen.
And it is not enough to just sit down and create a spreadsheet at the end of the year from memory.
No, that is called reconstructing records, and auditors absolutely hate it. They want contemporaneous records.
Meaning records created at the time of the trip.
Exactly.
But just use an app.
Use an app. Let the GPS do the work for you. It tracks the date, time, location, and mileage automatically. It is much harder for an auditor to argue with a GPS log than a handwritten note that looks like it was all written with the exact same pen on the exact same day.
I also noticed a really small but valuable detail in the source regarding what is actually included in that 70 cents. We said it covers gas and insurance. But what about parking?
Ah, yes. Good catch. This is found money for a lot of people. The standard mileage rate of 70 cents does not include parking fees and tolls.
Those are totally separate.
They are separate and additional. You take your 70 cents per mile deduction, and you can deduct your business-related parking and tolls right on top of that.
That is huge. If you are parking in a city downtown for client meetings every week, that could be hundreds of dollars a year.
Exactly. Do not throw away those parking garage receipts just because you are using the standard method.
Okay, so to recap the big aha moments here for you listeners.
Oh, for it.
1. The rate is up 70 cents for 2025. That is real money, especially if you drive an efficient car and can capture that arbitrage.
Definitely.
2. The year one trap. Starting with actual expenses locks you in forever. Starting with standard keeps you flexible.
Crucial point.
3. If you are a corporation, check your eligibility carefully because the easy button might be broken for you. You likely need an accountable plan.
That is a really solid summary. And remember, the source strongly emphasizes consulting a tax professional. Because while we are analyzing the rules today, Your specific situation, how much you personally drive, what exact car you buy, how your specific business is structured, completely changes the math.
Absolutely. We are looking at the map, but you are the one driving the car.
And tax laws constantly change. We are looking at the 2025 rules. Who knows what 2026 holds?
Before we wrap up, I want to go back to something you alluded to at the very beginning. We always think of taxes as paperwork we do in the spring, but you were saying this is really a purchasing decision.
It absolutely is. I want to leave you with this thought to mull over. We often go car shopping based on the color or the horsepower or maybe how many pup holders it has.
Of course.
But for a business owner, the car is an asset on a balance sheet.
Right.
When you are standing on that dealership lot looking at the shiny new heavy-duty truck versus the sensible, highly efficient sedan, you aren't just choosing a vehicle to drive. You are choosing a multi-year tax strategy.
That shifts the perspective entirely.
Are you buying a vehicle that needs the actual expense method to be financially viable because it chugs gas? Or are you buying a vehicle that is mathematically perfect for the high mileage standard deduction?
You are saying we should actually run the tax numbers before we even sign the lease.
I am saying that the most valuable tax planning happens before you spend the money, not after. Are you locking yourself into a tax method before you even turn the key? That is the real question you should ask yourself on the test drive.
That is such a powerful way to look at it. It stops being a chore and starts being a core business decision. It puts you in the driver's seat, literally and financially.
Exactly.
Well, there you have it. The car sitting in your driveway is more than just transportation. It is a line item waiting to be optimized. Thanks for breaking down the source material with us today.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride-Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 404-5858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.